It's clearly had a mechanical impact on things like job growth and GDP growth. That part's pretty easy. More people, more entrants to the workforce, you can put more people to work, GDP can grow a little bit faster. Maybe the more contentious part is what impact all of this had on wage growth and inflation, where we saw a big increase at a time when immigration was extremely low because the borders were closed and fewer people were coming. Then we saw a big decline in wage growth and inflation when immigration surged, and it naturally raises the question, is there some link there? My take is it probably did play a modest and secondary role as one of several factors. But I don't think it was the main story. Normally, a lot of people, I think, quickly think of immigrants as, well, you have more workers, that should help to rebalance the labor market. Economist is, of course, going to point out, well, now that they've come to the U.S., they're consuming in the U.S. as well, not just producing in the U.S. So you've boosted both supply and demand. And under normal conditions, I'd probably say, as I think most people would say, that it would be a wash, that it doesn't matter too much, that when we economists and markets think about forecasting wage growth and inflation, this is just not something at the top of our list that we're considering. I do think this recent episode, though, was a little bit different, because if you remember back to the beginning of the immigration surge, we had probably the tightest peacetime labor market in the history of the United States. So I think under those unique circumstances, where you had a huge supply-demand imbalance in the labor market, and in particular, the low-wage part of the labor market was just red hot, generating really hot wage growth. Under those unique circumstances, I think it's fair to say that an influx of another million, mostly low-wage workers, probably helped.
Paul?
So, David, given that backdrop here, how would you characterize the U.S. labor market? We've got, a headline of 3.9% unemployment, 3.8% unemployment. How do you characterize the labor market? How do you think the Fed views the U.S. labor market?
Yeah, I think basically we've restored the pre-pandemic balance, but things are a little bit more complicated. So if you look at a lot of different measures of how tight the labor market is, the unemployment rate, our jobs workers gap, survey-based measures, many other data points, and you just average all of them, the average is basically where it was in 2019, down a long way from 2022. I think the Fed would say that's ideal. In 2019, we kind of had in retrospect, the best of all possible worlds, abundant job opportunities, low unemployment, but we didn't have an inflation problem. By 2022, we'd probably overshot. 2019 was one of the tightest labor markets in history. 2022 was kind of drastically tighter. And I think most Fed officials concluded that's not the right place to be, especially when you have a big inflation problem. At this point, though, I think we can kind of say now, and in fact, we could say by last fall, that we have restored that pre-pandemic balance. The reason I say it's more complicated is that there's more dispersion among these indicators. They tell a less consistent story. And that means you can be a little bit less confident about where we are than if they all told exactly the same story.